All right, welcome to this explainer. Today, we're tackling a number that's dominating the headlines everywhere right now. And frankly, it's a number that kind of just breaks the human brain. We're talking about the United States national debt crossing the historic, genuinely terrifying milestone of $40 trillion. But today, we're not just going to gawk at it. We're going to look right past all those zeros to uncover the real crisis hiding underneath, what it actually means for the country, for the broader economy, and most importantly, what it means for you. Just think about the sheer scale for a second. $40 trillion. To put that into perspective, if you spent $1 million every single day since the year zero, you wouldn't even be close to that amount. Now, what's really interesting about this is that the raw size of this debt is actually a bit of an illusion. The true crisis isn't the giant pile of cash itself. It's the cost of carrying it. It's about what happens when the global investors who are holding the receipts start demanding a better deal. So here is our roadmap for the explainer today. First, we'll look beyond the $40 trillion. Second, the dangerous debt spiral. Third, the bond market stepping in. Fourth, the reality of no painless solutions. And finally, how this impacts you directly. Okay, let's dive into this first section, beyond the $40 trillion and the real warning signs. We hit this $40 trillion milestone just 5 months after crossing $39 trillion. 5 months. The speed of that is absolutely breathtaking. Yet Treasury Secretary Scott Bessent has actually pushed back on the panic of it. He recently stated, there is nothing magic about the number. And honestly, technically, he's right. A sovereign country doesn't just suddenly go bankrupt or become insolvent because it hit a big, scary, round number. What actually matters is our economic growth keeping up with the debt. But focusing only on that completely ignores a rapidly growing mathematical problem we're facing. Which brings us to Section 2, the dangerous debt spiral and accelerating deficits. And this brilliantly illustrates the terrifying reality of actually paying for this debt. Let's look at the net federal interest costs. Last year, the government burned through $970 billion. And that wasn't on infrastructure, it wasn't on defense, that was just on the interest for past borrowing. By 2026, that interest payment is projected to cross $1 trillion. And the projection for 2036, a staggering $2.1 trillion. The federal government is being forced to spend enormous, mind-boggling piles of cash simply to service the money it already borrowed. This brings us to an absolutely crucial macroeconomic concept, the debt spiral. It is a relentless cycle where a government has to continually borrow more and more money just to pay the interest on its existing debt. Think of it like paying off a maxed-out credit card with another credit card. This is exactly the trap that kicks in when a country's economic growth completely fails to keep pace with the speed of its government borrowing. Let's see how this builds in real time. Step 1, the government runs a deficit. Step 2, they have to borrow more money to cover that gap. Step 3, all that new debt generates new, incredibly heavy interest costs. And Step 4, those interest costs widen the deficit even further. Which, of course, forces the government right back to Step 1, needing to borrow even more. It is a vicious, accelerating feedback loop, and once you're in it, it becomes incredibly difficult to break. Just to really underline how rapidly these interest costs are eating up federal resources, the Congressional Budget Office projects that under current law, our public debt will jump from roughly 100% of our GDP in 2026 to around 120% by 2036. So the sheer burden of this debt relative to our total economic output as a country is just getting heavier and heavier. Moving on to Section 3, the bond market steps in as investors demand more. So you might be wondering, who actually enforces the consequences of this math? Well, it isn't the politicians in Washington. It's global investors. While the Federal Reserve controls short-term interest rates, it's the open bond market that dictates long-term rates. And right now, long-term Treasury yields have surged. The 30-year Treasury yield recently climbed above 5.3%, literally hitting a 2-decade high. And the 10-year yield approached 4.7%. Why does this matter? Because the U.S. constantly has to refinance its old maturing debt. If old debt that was borrowed at super low interest rates gets replaced by new debt at these much higher yields, the government's interest bill absolutely skyrockets. Investors are demanding a higher return to hold U.S. debt, which is making borrowing vastly more expensive for Washington. Now, Washington did try to handle this. The Treasury announced they would buy back billions in longer-dated Treasury securities. The goal was to increase demand, raise bond prices, and force those painful yields back down. And guess what? The strategy worked. For a few hours. Then, yields rebounded right back up, with the 10-year moving back toward 4.7%. So the crucial point is that the market effectively erased Washington's temporary victory, proving that the government simply cannot command global investors to do what it wants. That immediate failure led financial analysts and experts, including warnings from the Council on Foreign Relations, to describe these buybacks as treating the symptoms rather than the underlying disease. I mean, buying back bonds doesn't eliminate the deficit, it doesn't cure inflation, and it for sure doesn't erase $40 trillion of debt. It is merely a Band-Aid on a massive systemic issue. Let's look at Section 4, No Painless Solutions and the Impossible Dilemma. So how does the U.S. actually service this mountain of debt going forward? Lawmakers are trapped. They're facing an incredibly unpopular menu of options. They could raise taxes, which reduces private sector investment and is pretty much always viewed as political suicide. They could cut spending on major programs like Medicare, which is politically explosive, especially with upcoming elections. They could tolerate higher inflation to sort of inflate away the real value of the debt, but that erodes our purchasing power and pushes rates even higher. They could pray that we grow the economy faster than the debt, but as we've just seen, that's mathematically naive right now. Or they can just keep refinancing indefinitely, crossing their fingers and hoping for the best. When you break it down, there is literally not a single painless option on this menu. Which brings us to our final section, how this impacts you, the Main Street reality. It's really easy to look at $40 trillion and brush it off as just a Washington problem. But this collateral damage hits Main Street immediately. Higher government yields mean higher mortgage rates for everyday homebuyers. It makes corporate borrowing far more expensive, which means businesses have to cut operational costs, and that directly results in reduced corporate pay raises for employees. Commercial real estate becomes incredibly hard to finance. And for anyone out there with a 401k, it puts heavy downward pressure on stock valuations, especially in the tech sector. Because if investors can earn a high, relatively safe return from government debt, the value they assign to risky future tech earnings falls drastically. This debt crisis isn't abstract, it's a direct hit to your salary, your housing, and your personal investments. Now, to be absolutely clear, the United States is not facing an imminent default today. The US dollar remains the world's dominant reserve currency, and Treasury securities are still essential global financial assets. So the sky isn't falling tomorrow. But this $40 trillion milestone is a blaring warning signal. Our safety net is vanishing. The margin for error is getting very, very small. I want to leave you with this final provocative thought. Can the United States actually continue adding trillions of dollars in debt while magically keeping interest rates and inflation under control? The bond market is stepping up right now and sending a very clear message that the answer might be no. And if the market decides it just won't play along anymore, Washington may soon discover that the most powerful force in American policy isn't the White House, and it isn't Congress, it's the bond market itself. Thank you so much for joining me for this explainer. Keep asking the big questions, and I'll see you next time.